Good afternoon and welcome to BizTech's Asian Midday Market Watch, powered by the Smart Investors Singapore. Our guest today is Gabriel Yap, Executive Chairman of GCP Global. Gabriel is a REIT specialist and a top 20 investor in many REITs on the SGX. And we're getting his insights on the REIT space, looking back at 2022 and what we should be looking out for in 2023. Gabriel, welcome to the show.
Hi Brian, Happy New Year and Gong Xi Fa Cai in advance.
Gong Xi Fa Cai in advance, Gabriel. Now, for 2022, it was a tough year for investors. REITs are no exception. And I read in an article that you published that for S-REITs, there's a 40% chance of losing money on S-REITs, which for me was quite a staggering number. Especially because REITs are often seen by investors as a safe haven investor. Perhaps you can walk us through 2020 through your lens.
Right. I think, Brian, 2022 has shaken the foundation of REITs, essentially. As in our latest article, and your wonderful viewers can go to our website at GCP Global, SG, and look at our latest publication. You'll notice that we actually collated the number of REITs that posted negative compounded annual growth rate for the year 2022 compared to the IPO prices. And then even we add back the cumulative DPU that the REITs have been paying. Now we actually then calculate the CAGR, or for short, compounded annual growth rate. And the results are startling. Almost 40%, 14 out of the 38 REITs posted negative returns, as of last year. Now this has shaken the foundation of the REIT market, Brian, because in its 20-year history, everybody from fund managers, index funds, ultra high net worth to the common man on the street thought that REITs was simply good defensive instrument, a great asset class as an alternative to bond because of a higher interest rate, but that has been shaken and downtrodden based on the performance of last year.
And also, Gabriel, in an era of rising interest rates, REITs then have a bigger problem as well, because then suddenly bonds become more attractive. Especially now, Singapore bonds are paying, government bonds are paying above 4%.
That's true, Brian. I think the latest auction of 6-month T-bill in Singapore went down at 4.28%. The latest tranche of SGX, or what we call Singapore bonds, came close to 4%. So if REITs are paying like only 6%, the difference, the differential yield premium is ultra low. That's at 2%, and this has been the lowest in the last 20 years. This means that the defensive capability for REITs have practically evaporated. And more importantly, going into 2023, when interest rates are likely to stay high, elevated, as indicated by the Fed minutes last night, it is indicative that the key thing in identifying good REITs for one's investment portfolio going forward are very much the REITs that will not be so negatively impacted by higher interest rates as compared to what we see right now. So for this year 2023, the key thing is to go for defensive REITs, those REITs that position their balance sheet well, to actually encounter higher interest rates. And this is what we share in our quarterly REITs investment classes.
Now, Gabriel, in terms of key lessons, and there were many lessons from 2022. Besides what you just mentioned, what are the other things we should be watching out for in 2023 that could shape our investment decisions, particularly in the REIT space?
Well, 2022 is another exemplification of what I've written in my book, Making Your Millions in REITs, which is actually both above bestseller in Chinese in China market as well as in the US market, needless to say in Southeast Asia. One of the key things about making millions in REITs is the fact that one must always make sure that you can identify the rotten apples in REITs and not have it in a portfolio, because the fact that you have rotten apples within REITs in your portfolio means that the ability of compounding your money steadily isn't able to work its way through. And this is what you see in some of the really bad performing REITs like Lipo Malls, Manulife REIT, Prime REIT, as what we have highlighted previously. And it's played out nicely and perfectly in 2022. So the key lesson to take away really is to make sure your REIT portfolio is actually spruced up nicely. Make sure you have good REITs in your portfolio, and make sure you do not have bad REITs in your portfolio. And this is what we specialize in our investment classes.
Now, one of the key flavors of the year, of the month, for the last couple of years for REITs has been, particularly during the pandemic, it's been data center REITs. How do you see that performing looking ahead in 2023?
Right. Data center REITs, Brian, actually ran ahead of valuations, way back in the pandemic, simply because everybody thought that, wow, it's going to be a situation where you work from home. So the fact that data that's actually powered by the data center cap process, these are the ones would enjoy. And true enough, the likes of Keppel DC, MIT reached stratospheric valuation. So basically what we did is that when Keppel DC went up to $3 and MIT went up to $3, we actually flashed our warning sign in our REIT investment classes. True enough, the dividend yield went below 3%, the first of its kind in Singapore S-REIT history. And true enough, our warnings were well heeded by those who attended our classes. They took their profits both at $3, and you can see that both share prices have come down considerably. For example, Keppel DC have fallen by 40% down to 170 based on our warning at $3.
Now, Gabriel, as always, thank you very much for your insights and happy investing in 2023.
Once again, 恭喜发财, Brian, and to all your viewers.
Now, I'm Brian Fernandez, and we've been speaking to Gabriel Yap, Executive Chairman of GCP Global, on BizTech's Asian Midday Market Watch, powered by the Smart Investors Singapore. I'm Brian Fernandez. This show will be on our website, www.biztech.asia, as well as our social media platforms. It'll also be on our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.